the United States basically announced all other countries are our adversaries. Our number one adversaries are our allies. Our first adversary was England. Our second adversary was France and Europe. Our third adversary were third world countries. So you don't want to be a close ally or a supporter of the United States, because you will be, the more close you are to the United States as a supporter, the more it looks at you as an adversary, as you could see in Japan in the 1975 and 6 Plaza Accords and the other accords that wrecked the Japanese economy by 1980. Finally, in August 1971, it became apparent that the price for continuing U.S. military attacks was either to lose the shrinking gold stock, or you cut the dollar loose from gold. So the U.S. in 1971 ended convertibility of the dollar into gold. It stopped supplying treasury gold to the London gold pool, which it had been selling to hold down the gold price. And the gold price, of course, soared. And that ended the U.S. ability to exert world power through its near monopoly of monetary gold and credit to Europe. Now, many politicians worried that this would mean the end of America's diplomatic leverage over the world's financial system. Ever since World War I, the United States had dominated world diplomacy by its creditor position. It monopolized most of the gold and therefore the monetary base. And there was great worry in 1971 about what would happen when the U.S. economy no longer could do this. Other countries suffering gold outflows traditionally had to impose austerity. Hard money business economists in the US forecast that now that we're off gold, we're running a balance of payments deficit, the currency is going to go down, we're going to drive the dollar down, and that'll cause inflation. Indeed, Treasury Secretary John Connally depreciated the dollar's exchange rate by 5% at the same time that it stopped gold sales. And he said to Europeans, it's our dollar, it's your problem. So the dilemma that was posed for European and foreign banks. What happened after 1971, delinking the dollar from gold, turned out to be something quite different than was anticipated. Ending the gold exchange standard opened the way for a new form of dollar hegemony, one based on America's leverage as the world's greatest monetary debtor, not creditor. The great question was how Europe and other leading economies were going to cope with this glut of new dollars now that they no longer were able to get gold for their dollars. Central banks had little option regarding what to do with these dollars that were being pumped out by continued U.S. military spending and also investment buyouts to foreign assets. Sovereign wealth funds didn't yet exist. Central banks don't buy stocks or bonds, and they were not going to buy U.S. companies or real estate. So what central banks usually buy is limited to the securities and bonds of other governments. And the only major supply of such government securities were U.S. Treasury bonds, Treasury IOUs. So that's what central banks bought. Instead of the gold standard, the world moved on to a treasury bill standard. And here's the problem that this caused for foreign economies. If their central banks did not recycle their dollar inflows to the United States by buying treasury securities, then their exchange rates would rise. If dollars begin to flow into their economy, you have to buy their francs and now euros, and that pushes up the value of the local currency, just as buying Chinese exports pushes up the value of China's currency. If China doesn't take these dollars and then buy other dollar assets, it's not going to buy dollar exports more than what it needs for agriculture to feed itself, but it'll buy U.S. government bonds, which is why China became such a big U.S. bondholder, financing the U.S. military deficit in the process. If it didn't do this, that would rise the price of its currency and increase the price of its exports relative to dollar area economies, and this would reduce their volume accordingly. So to prevent the dollar glut from giving dollar area exports a price advantage, nations receiving a surplus of these dollars use them to buy treasury securities to support the dollar's exchange rate and prevent their own exchange rate from rising. And the effect was not only to support the dollar, but to finance the U.S. domestic budget deficit, U.S. Treasury bonds, which resulted largely from the $1 trillion a year military spending. So this was a new kind of international circular flow. And in order to understand world diplomacy, follow the money. You have to make a chart and see what is pushing dollars into the economy, where do the dollars end up, how are they recycled to the US economy? What happens to Chinese, Russian, or European currency that's spent abroad? Where do these dollars end up? Follow the circular flow. Is it on trade account? Is it on capital account for financial loans and investments? That's not done in any of the textbooks, but it's the obvious way that anyone can see what's happening. It's a new kind of circular flow in which the more U.S. securities foreign governments bought, the more they were hooked, the more they'd lose. China found that the more U.S. Treasury securities it bought, what if the U.S. would devalue? What if China would make a move that would hurt the U.S. economy? The U.S. dollar would go down, and the value of these U.S. Treasury bonds, as measured in Chinese currency, would go down. So China would lose in the RMB value of the dollars, just as Europe would lose in the euro value of a depreciating dollar. So Americans became quite explicit in playing this game, and they demanded that foreign countries recycle their inflows into the U.S. markets, but not to buy majority of U.S. companies. Only the United States, as the world's exceptional nation, can buy the commanding heights of other countries. And this became quite explicit in 1973 when the United States had quadrupled the price of its grain in order to increase its balance of payments. And so OPEC, oil producers, responded by quadrupling the price of their oil so as not to lose purchasing power. And State Department officials told their counterparts in Saudi Arabia and other Arab oil-producing countries that they'd agree not to oppose this price increase. You can raise your prices as long as these countries agreed to recycle their dollars into U.S. financial markets. And in fact, they were told that failure to spend the oil dollars, petrodollars, in the U.S. United States would be treated as an act of war. So partly, I think Saudi Arabian's king announced he was buying 1 million shares of every company listed in the Dow Jones Industrial Average. They bought treasury securities, they bought corporate bonds, and they also put a lot of money in foreign banks. So this flood of U.S. monetary spending abroad ended up being in the hands of oil-producing countries that were getting money not only from the United States, but dollar payments from Latin America, dollar payments from Europe for oil. And this money was basically recycled to the United States. And the banks that received these dollars that were being recycled lent them to third world countries to pay for their increasingly expensive grain and other imports. So you had an explosion of U.S. bank lending to third world countries between 1973 and 1982, when finally the Latin American debt bomb exploded when Mexico announced that it didn't have any money to pay the debt. The bank lending in the 1970s to third world countries was just as reckless as the junk mortgage lending in the United States in the early 2000s. The lending was made without any calculation of whether the countries that were borrowing these dollars would be able to pay it all. Now, the United States also played both sides of the creditor and debtor diplomacy. On the one hand, they took a pro-creditor position when dealing with third world countries and other countries running deficits. The Washington Consensus, really the Washington policy since 1980, called for the IMF and for bondholders to back very harsh creditor conditions in order to roll over the loans that they'd made and not foreclose on the loans of Argentina, Brazil, other third world countries. And the conditions, which are called conditionalities, imposed austerity conditions. Countries had to privatize and sell off their natural resources and their public enterprises, and they had to keep devaluing their currencies. And by devaluing the currencies, what they were devaluing was the price of their labor. Because basically a foreign currency is determined by labor costs, because raw materials have a common world price, machinery and other inputs have a common world price. The variable in international price comparisons is almost always labor. So a country trying to so-called stabilize its balance of trade and payments means impoverishing its labor force. This is one of the problems with a creditor-oriented international monetary system. So the effect was destructive and predatory, as European colonialism had been. European imperialism was hypocritical in claiming to develop the colonial periphery, and in reality, it turns its colonies and dependents into trade and monetary satellites. Well, America's internationalists, Washington Consensus, under the IMF, World Bank, and International Bondholders Councils, is just as predatory as European colonialism had done. It made third world countries into economic satellites and import dependencies. And it's turned them into rentier economies while financializing Western economies in a way in which local client oligarchies are supported, and America rules through client oligarchies that are assigned management of the public enterprises and raw materials being privatized. So all of this is being welcomed as a post-industrial, but it's precisely what classical economists from Adam Smith to Marshall, Thorstein Veblen, John Stuart Mill, all tried to avoid.